we had a really nice rally closing out on Friday, up more than 200 points. That was a nice turnaround to end the week, and that gave us a nice ending to the week, Derek.
Right. The Dow actually finished flat on the week. A lot of volatility during the middle of the week. The S&P and NASDAQ down 0.5%. But, that follows on a very strong week the week before after that bullish CPI number that came out. So, again, we're all waiting on the Fed. We're watching inflation. We're watching the economy. And there are lots of different headwinds and tailwinds. It's really a complicated atmosphere right now.
It really is. And one of the things that really jumped out at me was the interest rates on both the 2-year Treasury, 4.5%, and the 10-year Treasury, 3.8%. That delta, almost 70 basis points, is something that we haven't seen in a long time.
Well, it's the sharpest inversion of the yield curve, and by that I mean higher interest rates on the short end, lower interest rates on the long end, that either of us have ever seen in our careers. I mean, a 70 basis point inversion. And historically, when that 3-month and 10-year inversion goes negative, it has a perfect record of predicting recessions. But then at the same time, Goldman Sachs, fully aware of this, comes out on Friday and says they think the U.S. is going to avoid a recession. So the U.S. does continue to benefit from the strong dollar, which has kept inflation at bay here, and the relative oasis of our economy from a perspective of being somewhat independent on oil production and the rest. So we have a lot of advantages and a lot of things to be thankful for.
So let me go and try to clean a lot of that stuff up. So, of course, we have the inversion of the yield curve, and every time we've seen that at that degree, and we saw it in 2020, 2009 and 2001, and all of those had recessions in those years. But you pointed out something very important, and that is what's happening with oil, WTI crude, around $80 a barrel, and that is really counterintuitive to what we are thinking.
Right. I mean, we talked a lot about underinvestment in the energy patch. We know that the U.S. has been supplying reserves from the Strategic Petroleum Reserve, which has had put some downward pressure on energy. But we also know that China isn't fully reopened, and we know that drilling has gone way down. I did a slide presentation earlier this week, and you see that the number of wells that are drilled but not completed is way down, which is what future supply becomes. So there is a stickiness, I believe, personally, to the price of oil, which is one of the reasons why we like the energy sector tactically, particularly given the nice dividends attached to many of those companies.
And as we go into the holiday week, Thanksgiving coming up, people like to get into a better mood. But of course, there's also the time that it gets colder. And when you start to get colder around the country, especially in the northern part of the United States, you start to see natural gas prices going up. So you talked about China, you talked about natural gas prices. And one thing that's still out there, Derek, is Russia is continuing to sell more oil, but they're kind of doing it through the back door.
Right. I mean, in many cases, for example, India is buying that Russian oil at a discount, and then they're basically selling what they don't need to other countries. So, in some ways, they're arbitraging it. So the Russian economy hasn't been shackled as much as I think the alliance would like in terms of the sanctions that have occurred. But there were some rays of hope even over there. Zelensky talked a little bit about negotiating. Putin did as well. They pulled out of the province that they had taken. So there is some green shoots over there, which obviously would be welcome. At one point last week, we thought we were at the risk of a third world war, right, when those missiles went into Poland, but it turns out those were Ukrainian defense missiles. So there's lots of stuff to talk about, lots of geopolitical risk, but balanced portfolio is the way to go.
And there's no question about that. And folks, we spent a lot of time talking about politics in leading up to it, but we now know for sure that we're going to have a gridlock. And of course, the markets do like that. So Derek talks about both negative headwinds and positive tailwinds, and both of those really mean to go through those portfolios. And are you positioned correctly if we do get a soft landing, or if we don't in 2023? You need to recession-proof your portfolio, and that means going through asset class holdings and making sure it aligns with your full financial plan.